Hey guys, it's Kevin from NorthStarBuyCharts.com again, and I'm just here to talk a little bit about what's been going on with the precious metals. I'm going to focus on gold in this short video, and we'll take a look at what I think is the most likely scenario for gold going forwards over the next few months, the next couple of years. So I'll just stop sharing my camera, and I will start to share the screen. Okay, so what we're looking at here is the price action in gold since 1999, 2000. First, draw your eye across to the left-hand side of the chart, and you can see a low that was put in place there during the later stages of 1999. We saw a nice move up, bit of a consolidation, and then, of course, the precious metals bull market took hold. And we saw a movement of approximately 8 times, so a sort of a 700% rise for the price of gold, and it rose 8 times. So from $250, around about $250 there, to around about $2,000 up here, an 8 times move. That was punctuated by the 7 to 8.5 year cycle low in 2008. Actually in late 2008, I think it was October time. So that was fine. We then moved on to the eventual high for the cycle before it came down into the 8-year cycle, well, what is commonly referred to as the 8-year cycle low, but it's in reality, since the 1970s, it's occurred every 7 to 8.5 years. Okay, so every 84 to 102 months. Is basically the time span that you get between each of these lows. And this goes back, as I say, all the way back to when gold, when the US came off the gold standard in the 1970s, early 1970s. So that's all very interesting, Kevin, but what does that mean for what's happening now? Well, you might remember, if you've been following me for a while, that there was some question over whether we would break out to new all-time highs and then come down into the cyclical low from above and rest somewhere perhaps on this what would have been a support line somewhere above $2,000. It was either going to be that or that we were already progressing down into that major cyclical low. Well, I think we know the answer to that now. We're below the 3-year moving average, and we're progressing towards pretty critical support, and that critical support lies in the region between 1520 and 1560. Those were the lows that were broken when we moved down in 2012. We broke down in 2012, early 2013, and moved into this bear cycle period where it took several years for the price of gold to stabilize and then move up. So what's happening now is that we're progressing towards that critical support level, and at the same time, we're closing in on the window for the 7 to 8.5 year cycle low. So it seems logical that we're going to eventually test that 1520 to 1560 level. It's not guaranteed, and things can surprise us in the markets, and perhaps we don't go as low as that, and perhaps we turn around and perhaps we go on up to the upside, but there's no evidence for that at the moment. In fact, we can get a good idea when and if that's likely to happen just by simply drawing one extra line on the chart, which is that one there. So now we've got what myself and Patrick refer to as a wake-up line, effectively sort of trying to say that the price has gone to sleep and it won't wake up until it gets back up above that line. So we have that guiding us down towards this level, which would be late this year or early next year. And that would fit the criteria for the time and also for the price. If we break down below this critical level, then of course, that opens up the possibility of moving down to $1,400 or even a little bit lower. And that would extend out. I'm just going to extend this support line here. That would extend out the time period for that low, and that will probably take us into the middle part of 2023 if that was to happen. So in a nutshell, what I'm saying is that price is in a downtrend. Obviously, you don't need me to tell you that. But the important bit is to recognize that this is a major cyclical low that we're entering now. And why is that important? Well, it's important because what happens after these major cyclical lows, we get a new uptrend developing. And of course, I think with the precious metals markets, like any other market, we need to have very, very poor sentiment and people giving up and being convinced that it's all over before we can start a major new cyclical uptrend that's going to take us up perhaps by a factor of 8 again. So if we came down to $1,500, then a factor of 8, of course, would take us up to $12,000. So $12,000 sounds ridiculous, doesn't it? But that's no more ridiculous than moving from 250 to 2,000. Also at the bottom here, we have the rate of change indicator. You might have wondered what that is all about. It's a 7-year rate of change, shows how the price is performing in relation to where it was 7 years ago, whether it's been moving up, down, sideways. When it's above the 0 line, then the rate of change is positive, and when it's below the 0 line, the rate of change is negative. Important to note that when we broke down in 2012, 2013, the rate of change indicator was high and breaking down after a very long uptrend. Well, we've only just broken back out above the 0 line, and we're not high at all. We're quite low in terms of the rate of change. So it's not the same scenario, but what is the same is that the rate of change is testing its 3-year moving average. So the black line, the rate of change, is testing the green line, which is 3-year moving average. It's 43.67 is the actual value, and the 3-year moving average is 38.51. So we're getting very close to that. It could be a bullish back test, in which case it's setting itself up for a significant move to the upside. But if it crosses over, and particularly if it moves down to the 0 line and below, then we're in a much longer, much more bearish and damaging period of time for the precious metals. So that scenario can't be taken completely off the table unless we see the price of gold breaking out, and in particular, the price of gold breaking out versus the stock markets and versus the SPX. I've been showing that chart quite a lot recently. Gold has to break out versus SPX, and if SPX breaks out and moves up, then that is less likely. So we're watching the price chart for the S&P very closely as well, and watching how that interacts with its resistance line, which it hasn't reached yet. It's not near that at the moment. It's got some ways to go before it gets up to its resistance line. But the reaction of the S&P at that level, in conjunction with where gold is in time and price, will give us a very, very big clue as to what's coming next. So that's it for this relatively short podcast. I hope you found that informative. And as things develop over the next few weeks and months, there'll be more to come, of course. That's it from me, Kevin at NorthStarBadCharts.com.